And we're live. Good morning, man.
Good morning.
Or
Good afternoon. Yeah.
good afternoon, I
It's
should say.
it's good morning from you, and it's good afternoon from
There
me.
you
Yeah.
go. I always get
Yeah.
them mixed up, right? There
Yeah.
you are.
Yeah.
Well,
Time
hello,
zones.
hello. Hey, everybody. Thanks for joining us. We're going to do another live episode of The E-Commerce Leader. My buddy Michael Veazey from London, England. And of course, I'm Jason from Seattle. Seattle does not sound nearly as cool as London, but I guess it's all about the grass is greener being on the other side type thing.
I think so. I mean, the landscape around Seattle looks incredible to me. I mean, I love those mountains and the Pacific coast. I'm pretty jealous. I mean, London's cool when it's not locked down.
Yeah.
We've got world-class theatre. We've got incredible music. We've got all the things you get in New York or
Yeah.
LA or somewhere like that. But yeah, during lockdown, it's not been the greatest place to be. So,
Yeah, sure. Yeah.
anyway, so we've got an amazing topic today, man. I'm very excited about this. You just casually threw out the other day in one of our podcasts that you'd acquired, I think, 12 businesses in the last, couple of years or
yeah.
so. I'm like, wow, we've got to talk about that. That sounds seriously interesting. So that's today's topic. So really excited about this. Really different.
Yeah, I think this is going to be a good one. I kind of said to you earlier when we were sorting this show out that I thought we had sort of talked through the details of this for some reason, and I guess we just haven't. So this is one that I'm happy to share a bit more about and walk through details on, and I think people will get a lot of value out of this, even if you're starting out early in your journey of building an e-commerce business. Understanding how to do the acquisition side of things rather than building it from scratch is a good set of ideas to have in the back of your mind. So that's what we'll walk through with people today. Yeah. So, well, if you're joining us live for the recording here, then we'd love to chit chat with you in the comments. We're broadcasting this into our various groups and places. So wherever you're watching it from, give us a like, love, comment, shout out, hello, tell us where you're tuning in from. And we would love to have you ask us questions about the process or ideas related to acquiring e-commerce brands and businesses. What questions or concerns to you, uncertainties, doubts, worries, just things you're curious about. Happy to answer those during the live recording of the podcast. And plus, it's just fun to hang out and chit chat with people. So leave a comment and let us know where you're watching from. We'd love to be able to interact with you during the show.
Absolutely.
So are we ready to kick this thing off, Michael? Without any further ado, should we jump in here?
Let us, without further ado, and other doings, let's jump in. Let's do this thing.
All right, great. I think you're up for the kickoff here. So let's do this.
Absolutely. In a recent episode, Jason quietly shared how he's acquired 12 brands over the last few years. So in this episode, partly because I'm incredibly curious about this, we are going to dive into the topic of how and why to acquire e-commerce businesses. Jason, are you ready to share more on this fun topic, more specifically about your personal experiences?
Yeah, I am. This is going to be a good one. I'm really excited to have a conversation, share more details and ideas about how not only, I know, Michael, you're intrigued by this idea, but I hope all of our listeners are as well. There's something to learn here for everybody who's in the game. And I think it's going to be a great conversation. Yeah.
Yeah. So one of the first question is really, why should anyone be interested in this? I mean, let's put it broadly first. Okay, you've acquired businesses. We've got to ask you why you did that. But why is this a topic that is of something that people should be thinking about who are not yet thinking of acquiring?
Yeah. Well, I think it comes down to two simple questions that we can unpack and dive deeper into. The first one is, does it add value to your current business? Does the thing you're acquiring add strategic value or some kind of value? And there's a lot of different types of value, which we can talk about. But that's the first question. The second question is it available to you at a reasonable price? And I think those are obviously like duh questions and sound so simple, but there's a lot of nuance there and a lot of detail to unpack and think through. So I think that's sort of the first fundamental question. I'm not a fan of acquiring randomness just because it's out there. I'd rather have people acquire something that adds specific value to what they're currently doing. And I guess that's the kind of underscoring that first bullet point. That's the key thing, I think, to sort out and think about. Yeah.
I think that's true. And I would say, just to sort of keep the attention, pretty much everyone who's in the e-commerce game, I think even if you're not thinking of acquiring a business for a while, what I would say is very, very likely you're building towards a sale of a business. I
Oh,
know
yeah, sure.
20 or 30 Amazon business owners or former owners who sold their businesses. It's a very, very real thing. It's not a theoretical possibility. It happens every
Hmm.
week at the moment.
Hmm.
And
Yeah.
that is the flip side of buying a business. So if you learn to think like a business buyer, just as if you learn to think as a buyer of real estate or properties, of
Hmm.
houses, flats, whatever, condominiums, whatever you call them in America, then you're going to do a better job of selling your business because you're going to think like a buyer. So if nothing else, I would say to put that hat on, thinking like a business buyer, even if for you that feels
Yeah.
like something several years off, is going to be valuable in that way, really.
It's a great point, and I'll just say, I guess you're the one zooming out 30,000 foot view on
I
this
am
idea. So
just
that's
briefly.
well. Let me go there with you then. Yeah, just to add into the idea, I think the state of the union for e-commerce buying and selling is that it is just a hot, hot, hot market. There are so many people who can create, let's call it a version one business, and then want to sell it.
Hmm.
And they don't have the interest in operating it forever. It's not their forever thing, but they've booted it up and they've got it going. And there's just so many people out there doing it. And so it's created this environment where people coming into it are saying to themselves, why should I start from scratch? I don't know what I'm doing. I'm just going to buy something from somebody who's got it up and running already. And that's the environment in which we're operating. And it's just fun to behold. And so there's a huge amount of opportunity there. So I guess that's the 30,000 foot view of this, which is just to say this is not a hard to do thing right now. This is everywhere. This is everybody. This is so
Yeah.
like the thing. So I guess that's an important, first bit of this. Yeah. So
It is. Okay, so we looked at the why question, and you said add value to your current business, or does it add value and a reasonable price? Those sound, you have the knack of making things very simple, but obviously there's got to be a little bit more nuance to that. Otherwise, I guess we'd all be doing it. So, where are the nuances in this adding value piece, first of all? How do you
yeah.
assess that?
Yeah, I mean, I think there are a lot of ways in which something you could acquire can add value. The first thing is it a brand that you would be adopting into what you would be going from? If you have one brand now, you'd be going into a portfolio, a brand, a house of brands. Some people refer to it as, do you have one brand that's called a branded house? Like that's the only brand you operate under. Or are you like a consumer packaged goods company, like General Mills or a lot of the food packaging companies? They have tons of brands, like tons and tons and tons of brands. And so they're a house of brands. And so that's sort of the first decision. Are you going to be acquiring an actual public facing brand? Now, that might not be true. But it's one way an acquisition can add value. It might be just simply that you're acquiring a product that will feed into your supply chain. So just add value in terms of your sourcing strategies. That's awesome. You might be acquiring a team of interesting operators that you know they're doing a good job, and you don't have a team. you need people to do a good job, and in that way you're acquiring to hire. That's acquire hire as a phrase. And then I guess the most obvious one is it could provide steady cash flow, sales and profits to you, which increases the overall value of your core business. So what is that? 4 or 5 ways in which, an acquisition opportunity could add value to your existing business. And I'm sure there are many more, but it's just top of mind. Yeah.
I really like that. I mean, what you've given is 3 ways that are broader than I was thinking, more narrowly cash flow focused and profits focused. And I guess that's the traditional sort of private equity type model. In essence, everything gets reduced to a series of spreadsheets and financial statements. And you're looking at a much more blend of that plus the operational and branding mind that you bring. And in particular, that brand to portfolio is very interesting, isn't it? Because on the one hand, you have people like General Mills in the UK will have Unilever that actually own 20 different, like, I don't know, they own, I don't know who owns Colgate toothpaste and this and that, but and Oral-B toothbrushes, for example, in that vertical.
Yeah.
But actually a lot of things that we think of as consumers as being X company are actually owned by one big company.
That's right.
And the opposite, I guess, is true with somebody like Google, who acquired YouTube. They acquired AdSense. They acquired, what was it, the Google keywords tool back in the day wasn't even created by Google.
Yeah.
And yet those are kind of feel like core parts of the operation now. So they've kind of subsumed them into the
Right.
Google brand, the unified experience for advertisers like us or consumers who search. So I guess there were two ways to flip with that, right? What are your
Mhm.
thoughts on that?
Yeah. I mean, you laid it out correctly there with those ideas, right? Google could have gone with Google Video and just made all the YouTube stuff called Google Video. They had a thing called Google Video, but they didn't. It had a brand associated with YouTube. And when they acquired it for $1 billion, I think the numbers are insane. I think this is just, from memory, but I think they acquired it for like $1 billion. And then I saw this article that said YouTube now makes $1 billion like every 3 weeks or some crazy thing like that. And that might be incorrect, but you could Google around and find the real numbers. But it was insane. And but yes, they kept it as a standalone brand because it had brand equity and value. And but you get these choices when you're going to acquire, and so that is a fun part of the exercise. The question is, is there a brand there that has value, and that means not only just registered trademark and the intellectual property associated with it, but it also has customer loyalty and traffic and energy and enthusiasm, all those things. And that's through, and it's these are the choices you get to make. So.
Yeah, another interesting one that springs to mind in sort of bigger company pictures, Innocent Smoothie, which was acquired infamously in some ways by Coca-Cola, because obviously the brand values of Coca-Cola and those of Innocent somewhat conflicted. So I suppose sometimes you can have a bit of a conflict between the sort of natural consumer base of one
Oh,
company
yeah.
and the other, right? But
Mm-hmm.
I guess that's something else you got to think through when you're
Yeah.
acquiring something.
Yeah. Sure. Yeah. That's good.
The other thing I like is the supply chain piece that you mentioned. I mean, I was speaking to somebody Stephen Pope, who runs My Amazon Guy, so another Amazon agency, and he was saying he sells products made of glass. He said, like, I'm into the vertical integration right now. My solution to the problems of importing is don't import. Not only own, buy from a factory in
Yeah.
America, but preferably own the factory. And he said, basically, I want to own the sand that is then turned into glass in the factory, and then I want to own. He wants to own the kind of whole supply chain. So obviously, I know that you and Cinnamon have done quite a lot of acquisitions along those lines. So tell me a little bit about that sort of reason for buying.
Yeah, I mean, I think it's an interesting play for people who are building their overall enterprise value, and that's an interesting example you mentioned about the guy wanting to own the glass making process if he's a front end seller. I think that's the question is, are there resources available to you that would lower your overall future costs and or solidify your supply chain in such a way that it just makes your business stronger? It's vertical integration is the phrase, I guess, but that sounds fancy, but it's really not. It doesn't have to be that fancy. You can do this. The kitchen table entrepreneur version of this stuff is totally workable. Yeah. And so yeah, we continue to acquire brands, and they make sense for us to acquire. We operate, and I mean, I'm happy to explain the detail a little bit. We operate a marketplace with over 100 and whatever 15 brands or whatever, and something like that. And we have our own house brand. And the people we work with sometimes are wanting to exit. They're done. They're retired. They're moving on. They've found other things. They don't have the energy for it or whatever, or they just want to make a profit from their work. And so we're buying those as they come up, and that's a fun opportunity for us. And then it just turns it in in essence, in Amazon terms, it turns it in from being a third party seller on our marketplace to being a house brand. And that makes a ton of sense for us. And it is a rewarding process and enjoyable. And we've had really positive feedback from the people we've done the deals with. So that's a way in which it's a win-win for everybody involved. And from the customer facing point of view, it's a win as well. I mean, it's a win-win-win all the way around. It's positive. And it's an exciting little journey we've been on the last couple of years. Yeah.
It does sound interesting, but what is your reason for doing that? Can you just explain why you would do that?
Sure. Yeah. I mean, if you think about math on long-term royalty payments, long-term royalty payment is I, as the publisher, agree to pay you a royalty on future sales forever. Now, that's a long-term commitment on my part to do monthly math and payments, and but it's all a caretaker role in a way, and sort of a marketer promoter role in a way, if you're the publisher and marketer of somebody's royalty based work, intellectual property work, then but then on their side of the deal, that means they'll get a residual payment for a long, long time. That's relatively small amount, or it's an amount, but if stacked up over 10 years, the monthly payment looks like a small amount of it. So it's an opportunity on those people's side to say, I would like all the future payments right now. How far in the future are you willing to pay me for this future royalty stream? And can we make that deal? And that's the simplest. That's the basics of it. It's just we're solidifying our catalog and portfolio and our brands, and they're getting a one-time payment rather than small payments over a long, long, long time. And so it's just a unique twist of because we're operating a marketplace. But we've done other deals outside of that structure that I'm happy to talk about as well, that are more straightforward acquisition of random outside kind of companies and brands. And so but yeah, so it's a little bit. So the question is, does it add strategic value to us, and does it make a lot of sense for the seller? Yeah.
Okay, so you've mentioned the how much are you willing to pay me question. So I guess that brings us to the price question, which was the other one of your two criteria. Does it add value to your brand or make sense? And
Uh-huh.
is the price reasonable? That's
Mhm.
a huge question. How do you even begin to tackle the question of the right value?
Yeah, so there's different ways to value a business, and then the question is, can you come to consensus on value of the business? And so the first question is, does it generate earnings? Is a profit being made in the enterprise? And if there's profit being made in the enterprise, it makes it fairly straightforward. That's a very common scenario that many people have done, and so there's simple industry standards, and it's just you do a multiple of the annualized earnings. So you ask the person to do a prior 12-month profit and loss statement. How much money did they actually, top line sales and then profit, and then usually they have to say, well, this was profit, but I bought a new MacBook, and so it was a discretionary spending on the owner's side or whatever. So you come to some rational, consensus on the earnings, and then you do a multiple of that, and frequently that's anywhere between 1 times to it could be 5 times or 7 times annualized earnings. The depends on the hotness of the property involved, and the brand, and how many people are interested, and how fast they're growing, a whole bunch of factors. But you make an offer based on a multiple of the prior 12 months earnings, and so that's some sellers will immediately warm up to that idea, and some sellers will just not want to go there because they don't feel like there's earnings that are materialized in the way that they had hoped, dreamed, planned, or thought would occur. And so that's one whole bracket of how to value. And then the second bracket is if it doesn't have any earnings. There's still a lot of businesses that don't have any earnings being operated that still have ton of value in different ways. Maybe they have a intellectual property, like a patent or something. Maybe they have an amazing product and there's just not been margin there. Maybe they have a great team. Maybe they figured out something, on the marketing side, social media side, that's really, really hopping, but it hasn't resulted in net profit. And then the question is, how do you value that? Those are harder, I think, to put value on, but nonetheless, it can still happen. And then the question is, what's the basis for that valuation, and how do you get to that conversation and that kind of thing?
Yeah, that's a fascinating question, is how to value things. And valuing things on the multiple of earnings is very, very standard indeed, and
Mm-hmm.
talked about a heck of a lot in the FBA
Yeah.
private label world. Which doesn't mean that, by the way, this is why I think every single business owner should think in these terms that we're discussing today, even if they
Mm-hmm.
never actually, buy a business or sell one, because the value of your business, folks, in general, if you're selling on Amazon, it's pretty simple. It's between 2.5 and maybe 3.5,
Yeah.
if you're really lucky, of your
Okay. There you go.
trailing 12-month earnings. So if you have no
Mhm.
earnings, you have no value to your business in essence, unless you can sell off the email list or something,
Well, but I
which
would
is
just
a good
say, I
reality
mean,
check.
that is valuable. I mean, if there are valuable assets in a business that's not earning any profit,
True.
and that's and so if you've got a high revenue rate and no profits, you don't have a zero value business. And I would just caution people to not dump something that's, misvaluation is the name of the game. Like, that's how people win and lose in this scenario, is misvaluing something. And so, if you do have items in the business that clearly someone would have to pay to create, that's a way to look at it. If you would have to, it's like a replacement value idea. If you would have to pay to create a list of 10,000 email subscribers, or pay to create, a product, and that's being manufactured in China, then that's somebody else might pay you for that. So there you go. So anyway, I didn't mean to interrupt, but yeah.
No, but that's fantastic, because that brings me to the a little thing that's happening in the mastermind at the moment. Obviously, can't share specifics, but I was approached by one of the mastermind members because they have a company that they've been talking to, which is in a related industry, similar products to what they have, and they're basically selling up as a mom and pop business after 40 years in business or something, and they couldn't get any responses. So the first thing I said is, they say the fortunes in the follow up. Why don't you send them a registered post? Actual physical letter. The owners in America and the guys in the masterminds in the UK, and then phone them and email them. And lo and behold, they did get a response. These guys apparently have several 100,000 email addresses for a customer database, but not many of them are active. And then, this guy sort of said to me, "Look, I know you think about this sort of stuff a lot, Mike, famous for obscure thinking, obviously, at this stage of the game." And he said, "How do we put a value on that?" So I gave him a few thoughts, but that's an interesting case, right? So they have been trading, but it's not a future trading company. They're buying so much as a list of people interested in products in a category that they also sell. So that's an intrigue. That's an example of what you've just been saying. The kind of replacement cost of finding those people might be actually quite a lot of Google AdWords, running a website, email campaign writing, and so forth. So how would you value a deal like that if you came across it?
Well, I've done that before, and so I have done a deal like that. Actually, I've done 2 deals like that, actually. And the first deal, the owner just asked me what I thought the business value was, and it was basically, losing money every month. So to buy that, you're buying a horse that eats. That's the phrase. Like, you got to feed that horse. You're buying something that you have to invest into the next month after you pay the original owner. And so I've done 2 deals like that, and happy to do it. Now, in the first case, the business owner had no idea. He wasn't sure there was how to value it, or if there was value. And I just made him an offer, and I made him an offer that was so ridiculously good for me. I was going to be happy if he said yes. And if he said no, I would chalk it up to me being, kind of, let's call it frugal or conservative in my valuation. Because I knew that there was, in the next 12 months, I knew how much I would have to spend to keep this thing going. Well, that was a fantastic deal for me, and it was it went through, and happy as a clam. And he was happy too, and he got rewarded for his work. He didn't think there was value there, and he got a check that was a sizable check to him, and I got a brand that I'm happy with. In another scenario, we did a deal, and the owner clearly had a value in mind. And the value in mind was, just the valuation based on work and effort, and not based on earnings, but based on the sunk costs, I guess you could say. What had gone into making it. And in that scenario, we didn't really have an opportunity to budge much on the pricing. But here's the trick. This is like real estate in a lot of ways. If you're familiar with real estate, deals and that kind of thing, we negotiated on the terms of the deal a lot. And actually, there was plenty of pliability and flexibility, and kind of, I guess you could say, negotiability on the terms of the deal. And so then that just totally made it work. So we're like, you'll get your price, but here's what we need to make that a reality. Done. And so that was how that worked out, and we're happy as clams. and it was a successful exit for that person as well. And that's just, it's turned out really, I call that our deal of the decade.
I like it.
And
I mean, I
yeah.
think you make an extremely good point when you were warning not to kind of throw the baby out with the bathwater in the phrase we use in the UK. I don't know if you use that in the US. It
Sure.
sounds a
Yeah.
bit alarming, but
Yeah.
in other words, you've created an asset of value, even if it's actually losing money. As you said, buying a horse that eats. I like that phrase.
Yeah.
So that's actually, I think, increasingly valuable. There's a nice synergy there between
Right.
somebody got something that nobody else could actually use, but if you happen to be in the same space or you want to enter the space, it's
Yeah.
actually value to you as a very specific buyer, isn't it? Like these guys who wanted to buy an email list of several 100,000 people
Yeah.
in a very specific area. To me or to anyone else that I know, it would be completely and utterly valueless.
Yeah.
But these particular people, it's actually a value. And then there's
Yeah.
it comes down to the match between the gap that the buyer has, I guess, and what the seller has to offer, right? I guess
Yeah.
that's what.
Totally. And you're right. It's really, people would ask the question, well, why would you acquire something that you have to spend money on the next month in addition to what you paid for it? Like there's no profit. Well, it's because there's strategic value, and it's because it's bolting onto something that I already have going in a way that adds value to what I'm bolting on. And just think of it this way: if you've got an engine in your vehicle that's generating profit, but you don't have a trunk or a bumper or a hood or a roof rack, then those things don't have to add a profit, but you still need them in your business. And so, what you're doing at the owner level is you're saying to yourself, how can I make what I have more valuable? And a lot of times in our mind, we do that thinking when we say, I'll spend money on Facebook ads. I'll spend money on AMS ads. I'll launch a new product. And all of those are good strategies, but acquiring another company that would add something interesting to the party is also incredibly valuable. And you mentioned email lists. Of course, that's one of the things that's valuable. You can have a really large email list and not be making any profit, but to someone else who has the product suite that's of interest, that could be very valuable to acquire. So there you go. Yeah, I mean, I think this is how to look at it. Yeah.
Yeah, it's interesting, isn't it? The things that people often will, as marketers, forever and ever talk about being valuable assets in your business, such as a list. The money is in the
Mm-hmm.
list is the famous phrase. And I believe
Mm-hmm.
it to be true. And yet people don't tend to be in the mood to actually pay money for the list. They'll hire lists from list brokers. They'll build their own list, very
Mm-hmm.
common activities.
Mm-hmm.
And yet there doesn't seem to be a thinking of as common as it is, like this guy I'm talking
Yeah.
to potentially is going to do it. You've done it a couple of times. So I think that actually, to me, that means there's probably better value to be had, because if
Mm-hmm.
everybody's doing something, that tends to push the price up. So
Mm-hmm.
Amazon ads, Google ads, Facebook ads get incredibly expensive now as a
Mm-hmm.
customer acquisition strategy. I'm not saying one shouldn't do it, but I think fishing where the fewer people go is generally going to give better value, right? It certainly seems to be your story.
Yeah, totally agree. Sure. Yeah.
So let's talk about how you assess the return on investment or the upside. I mean, I suppose we ought to differentiate between things which have existing cash flow versus the ones we've been talking about. But obviously, you've got an assessment to make before you get into how to do it. So how do
Mm-hmm.
you even go about that?
How do you assess the business?
Yeah, how do you assess the upside potential or the return? So, for example, if you're
Right.
going to
Yeah.
buy
Mm-hmm.
something that the horse that eats,
Mm-hmm.
how do you assess that that's going to make you money in future? How did you
Mm-hmm.
go about making that decision?
Yeah, well, two different scenarios. Again, it goes back to the, does it have earnings or does it not have earnings? If it has earnings, then what you're saying to yourself is, in the process, you're doing what they call diligence or due diligence. You due diligence. Uh, the question is, are those numbers phantom, illusory numbers? Are they a mirage that someone's constructed so that you'll buy their business, or are they legitimate numbers that you can say, okay, if this isn't a scam and this is legit, and I inherited this stream of sales and profit, how far into the future would I break even? And so, just in round numbers, let's just say you buy something for you buy something that's earning let's just do this simple small math. You buy something that's earning $1,000 a month, and you buy it for $12,000. In 12 months, you're going to be made whole. In essence, on the 13th month, you're going to have broken even, and you're going to have just all that profit fall straight to the bottom line without the obligation of that original purchase. And so, how far into the future do you want to go? Is that how far you'll pay? Would you pay for 24 months into the future? Would you pay for 36 months into the future? How much are you willing to pay to acquire that future break-even point? And that's just with the current asset as it currently exists. And then, of course, all of us as entrepreneurs say to ourselves, can we add strategic value? Could I double the sales of this thing I'm acquiring? Or could I make it more profitable? And a lot of the ways that people do making it more profitable is you have your existing assets in your business. Let's say you have bookkeeping services and a CPA, and you've got virtual assistants, and you've got a social media team, and you've got all of these things that you put together to run your current business. And to acquire something new, you could take out a lot of costs, and taking out costs means that you'd be more profitable. So that's a very, very, very common. I mean, that's been around forever. Is just mergers and then elimination of expense, redundancies, and you get to new profitability levels. So that's one way to think about this. But you don't want to be over aggressive in your thinking. You want to just say, if I just took this, how long would it be until it started paying me real profits that are new money to me after I've spent the money to buy it. So that's how to think about it. And all of us have different levels of risk. Now, if you've got a lot of cash on hand, you could say to yourself, well, I'm willing to buy something and I don't care if it doesn't pay me anything for 4 or 5 years. Well, fair enough, but that's a long time to wait.
Yeah.
And so, that's the calculation on it. And, you're not trying to rip anybody off. You're not trying to be uncool to the buyer, to the seller in this process. You're just trying to think through what makes sense for you and what sounds appealing to them. And obviously they want to be paid a big amount for their assets, and you want to pay as little as possible. And the truth has to fall in the middle in an acceptable way for both of you.
Yeah. It's interesting that you bring up the issue of the cash flow, or how, or the sort of, I suppose cash flow, can't avoid that word really. One of my favorite words. In other words, you're thinking about how long it takes you to get your money back, and then after that, it's all gravy, it's all profit. And then, of course, the elimination of expenses piece, as you said, that's more of a sort of so it's strategic acquisition thinking, or sort of roll up thinking, isn't it? So the more things you bolt on, the back office functions stay about the same, and maybe they expand a bit, but you don't have to buy a whole new bunch of people in. But what's interesting to me is that feels, for starters, a bit like the thinking that if you're a private label seller, particularly if you import and you sell on Amazon, that's very much the thinking you have to think. It's just you add another zero to the time frame. So instead of thinking I'm going to lose money on this product for 3 months, and then the 4th month I hopefully pay that money back, and then in the 5th, 6th month onwards I'm into good profits. And it feels very similar, except instead of thinking months, you're thinking years. So that feels not that dissimilar in
It's
terms
ROI,
of
ROI thinking.
mentality. But also the cash flow thing comes in, which then brings me to the question of, without getting into the weeds too much, but the basics of the deal structure that you were talking about. Because obviously, if you have to pay all the money up front, then you've got to wait. Say if you pay 3 times annual earnings, you've got to wait 3 years to get that money back, right? But presumably you would have structured deals a little bit differently. And what deal structures have you come across in your own personal acquisitions?
Sure. Well, usually sellers want money immediately before they give you anything. So, I mean, there's different ways you can finance it. I guess, is that sort of the question, is how do you finance your deals, or what are the deals types? Yeah.
Yeah, I suppose it means when do you pay money out of your accounts? The cash flow from your perspective, really.
Yeah. Well, so different deal types would look like, you can just write a check for cash, and it's a one-time transaction, wire the money, and then they give you all the intellectual property and assets, and login passwords and details and all the business assets. You can do that. You can and you can use just earnings you have on hand, money you have on hand. You can use loans. A lot of us who have money flowing through Stripe or PayPal or anywhere, if you have a Dun and Bradstreet's number in the U.S. I don't know how the system works in the U.K., but if you're a known business operator, you're getting literally pitched loan offers all the time. So business credit is just sloshing around the world like crazy. So there's tons of money out there if you want to use a loan product. So you take a loan, you give the full amount to the seller, and they're made whole immediately. They give you all the business assets, but you really only made the first loan payment, maybe, then, or, within a month or whatever. So you just finance the deal over time. That's very straightforward. You can also then, if you wanted to, you could also just ask the seller if they would take payments. So that's another, that is seller financing in real estate terms, but you could just ask them, would you take payments? They might say yes to that. In which case you could just do it from, earnings, from your current cash flow, or you could still take a loan. So if they're taking payments and you'd take a loan, you're really talking about very minimal, front end money needed on your side. And then I would just say, the fourth way you could operate is if there's something big and you want it, it's like there's a big deal, you want it. You could always find an investor, a strategic partner, and take the opportunity to somebody like, hey, I've got an opportunity to buy a company, but it's a little bit outside my reach, and I'm looking for strategic investors. I'll manage it all, and but here's the deal. Now, to do that means you've got to sell that person on the merits of the deal. You also have to have a deal with them to clarify how they're going to get rewarded, and that gets complicated. There's different ways they might want to be rewarded. They might treat it like a loan on their side, where they just want money back at an interest rate. They might treat it like they're a part owner. So they kind of have like this equity owner's share mindset. But those are legal issues. And so you want to, that's sort of deeper into the swimming pool. I would say those are not for the new first time, deal doer. So that makes sense.
That does make sense. Very briefly wanted to ask, because we should ask about a bit more about the how. I guess we're beginning to approach that. But one thing I just wanted to say is evaluating risk. Now, obviously, that's not kind of a sexy word, but obviously when you're putting your own money down for something, I guess you want to know what's the potential for it to go to zero, or if you to lose some money, and how do you deal with that and evaluating that, and how does that affect the price you pay?
Well, yeah, it's a great question. I would say the simplest way to evaluate risk is have a set of due diligence or diligence questions that you sort through, that you have all the questions in your mind answered related to the business operation. That could take a couple conversations, couple hours, and it'd be methodical about it. Don't just go rando into a Zoom meeting with some seller and start just free forming the stuff. You probably would want to make a list, send the list to them ahead of time, and say, I want to ask and answer these questions, and have answers to them. And so then they know kind of what you're looking for. And so that's a nice way to approach it. And, you can Google around and find out, what, there's everything's available on the internet. What questions should I ask when buying a business, or, stuff like that. And so you want to sort through that so that you're just comforted in your own mind that you understand what you're acquiring. Now, if this is a very similar business to your own, maybe it's a competitor or something like that, and you really operate in the space already, then you're going to know a lot about the industry you're stepping into, because it's your own, it's your own space, it's your own niche. I would start there. If you're going to do a first-time deal, I would buy something that is so in your wheelhouse that you have many answers, but don't assume you know everything. Still go into it with a real strong case for inquiring. Now, the big challenge in that scenario, when you're dealing with a potential competitor, or at least in their mind they're a competitor, is if they're really still amped up about being a competitor in their mind, and they think there's a lot of, they still see a lot of value in what they've created, they will not want to disclose business details to you for fear that you'll somehow benefit from the disclosure of information. Now, if they're a failing competitor and you're a winning competitor, then in reality, you don't want to be unkind about it, but you could just say, well, I know, no disrespect, but I know everything about this industry, and I know how to operate this business. So I do know a lot about it. Now, you don't want to come off as sort of this weird, I'm going to buy you out and I'm better than you, or anything like that, because that'll just tank the deal. But you do want to go into it asking those questions from a first, I guess you get first principles point of view, or a beginner mind, where you say, tell me about your business. How does it work? You might learn things. Now, they might ask you to sign an NDA, or that, they might not really want to be forthcoming with details. Like maybe they don't want to disclose a specific vendor relationship, that is a closely held relationship, and you don't know who their vendor is, but they're making a lot of money. You could ask them a ton of things about that vendor without saying, tell me the name of the company or tell me who it is. You can find out all the business information. And so these things are all going into your mind to say to yourself, am I satisfied that I know what I'm doing? And then I'm going to, put my money on the line. And in general, best suggestion would be go slow, start small, do one deal. And, that sort of helps you understand, whether you're good at this, and in that way you kind of get your handle around how to assess risk and whether you can do it well, so.
Yeah, great point. So I guess go slow is always a good starting point. There seems to be this tremendous overly artificial sense of urgency knocking around
Yeah.
e-commerce somehow.
Yeah.
I guess that's just created by good marketing for, Amazon courses and whatever else. But the truth is that there's no rush really. So thank you for that. And starting with your industry totally makes sense, as you indeed have done. You and Cinema have done the majority of your acquisitions bang within your wheelhouse, right? You know it extremely well.
Mm-hmm.
So that's all
Mm-hmm.
the sort of preludes to what you should be looking at, the risk stuff. So the how piece, what are your tips on how to actually go about this?
Yeah, a couple tips. Yeah. The first one I would say is don't buy retail unless you have to, and you don't have to. So, and what I mean by buying retail is there's a ton of marketplaces now for buying companies. Shopify has a marketplace for buying companies. There are other marketplaces like Flippa, Empire Flippers, MicroAcquire, FE International. There's business brokers that are out there that have constantly, have new listings, just like real estate, really. And stuff's out there. That stuff is what I would call full retail. I don't think that's the best place to find deals. The best place to find deals is relational connections and meeting people in the marketplace, knowing them, being in touch with them. And this is how our best deals have come together. And so you put yourself out there and you say to your network, I'm looking to acquire brands, and I'd love to chat with you about that. And that's a networking thing. The reason that's so incredibly more valuable than paying full retail is you'll end up hearing about people who want to sell but aren't really, I guess you could say, they're motivated sellers in a way. They're selling because they're done. They want to retire. They're exhausted. They've just given up on their business. You'll find people who have business assets that are more in the category of unwanted than anything else. And if you go to just Flippa or Empire Flippers, what you're stepping into is a scenario in which the sellers there are fully ready to maximize the value of their asset and have it all shiny and happy and a story to tell. And they're gonna impress you with how things are sorted out, and you'll pay full retail for that. And so I guess what I'm describing here is being a value shopper in a way, and finding things that are the less loved assets. And you know what I mean? It's just, some people, because business is a venture that you go into, you always leave. Everyone always quits at some point. You want to find people who are ready to get out of it. And those create the buying opportunities that are more valuable. And it's just like real estate in a way. So that's how to look at this. First tip.
Interesting, isn't it? That sort of, by the way, super smart insight. I guess I've spoken to a ton of business brokers and business acquirers for the podcast over the last 3-4 years, especially in the last few months.
Yeah.
As you say, it's a feeding frenzy. It really, there's such a big market for buying and selling e-commerce businesses right now. It's absolutely insane.
Yeah.
But you're right that those are the guys talking about, creating a sort of shiny looking business
Yeah.
and getting great value for the seller, but as the buyer, it's not the value place.
Hmm.
The interesting thing about the motivated sellers thing, that has a bit of a funny sort of feel to it in the real estate market, because obviously it feels a little bit like you're trying to take somebody's home away from them and under the
Hmm.
value that you quote should or shouldn't. I
Hmm.
would say that you can feel a lot better about, I don't know, buying, for example, an email list of several 100,000 names, which is pretty much valueless to the general market. Or in the,
Yeah.
couple of acquisitions you've made outside of your, the what do you call it, Pixie Fair,
Hmm.
that really, if they didn't sell to you, they were probably going to sell to nobody, right? So in a way, I
Right.
think you're adding huge value where there was pretty much nothing,
Yeah.
and I think you can feel pretty good about that. I mean, what's your feeling? You've done that a couple of times. How did you feel after the deal?
It's uh oh, I'm happy about everything we purchased, to be honest. I don't feel like we purchased anything that was a fail.
Mm,
Um and you're right. I mean, the cynical person would say, you know, there's something wrong going on. But if you find a buyer, or sorry, if you find a seller who is done, they're exhausted, they don't even have the energy to market their company, and you say to them, "Hey, I'm happy to give you a fair price. Let's just make this easy." You're doing them a huge service. You're right. I mean, many times some of this stuff would just be like, "I quit. I'm giving up. I'm shutting down my Amazon account," or whatever, shutting down my website. So those people, if you can find them and if you can talk to them and broker a deal, you're doing a huge value. You're offering them a huge value. So there's no shame in that. I mean, I love Warren Buffett's investing style, and I love his early writings and his early story. And if you've never really geeked out over his story, go get the book Snowball. But then can also read the Berkshire Hathaway annual letters. Charlie Munger and Warren Buffett described their early business, acquisition efforts as what they called um, taking the final puff of cigar butts that they find on the sidewalk. That is such a horrible idea. They'd find a cigar butt, they'd take a few puffs, they'd light it up. That's a horrible way to describe what they were buying. But their idea was they were finding businesses that had some value and life left in them that were relatively easy to acquire, and that they found value in, that the other people didn't, that other people had discarded. And I remember one of their deals they talked about one time. Warren Buffett told the story that I think it's in Snowball, and it was about a cartography business, like a map making business, and it's over time its top line numbers had gone down, 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 going down to zero. And but as it happens, they had an investment portfolio of, I think it was like $4 million of these really good stocks. Well, on the basis of the profit of the business value is really, really low. But on the balance sheet, they had this investment portfolio. So, he bought that business for a song. And what he was really buying was that investment portfolio that the company controlled. I think it was in their pension or retirement program or something like that. And so, that was one of the ways he did it. So these are the ideas you want to think about, and you don't want to look at it as being anything other than helpful. And that's what you're being. And there's opportunity to be helpful for e-commerce sellers who are done being e-commerce sellers.
I couldn't agree more. And by the way, I think there's so many people to shut down Amazon businesses in two ways that are completely wrong. The first one is deluding themselves that anyone is going to buy a bunch of stock that didn't sell. If it didn't sell, then
Hmm.
it isn't going to sell for anyone else, probably. And
Hmm.
by the way, over 6 months, the market would have got twice as
Yeah.
competitive. So if it didn't sell 6 months ago and you ordered it and you're now trying to sell it 12 months later, that's not going to be better. But the flip side of that is they don't value the hidden assets.
Hmm.
Yes, the
Hmm.
profit may not be there, but you have 10,000 Instagram followers where you have a fantastic relationship with them. You were just lousy at doing the economics of ordering, for
Hmm.
example.
Hmm.
The flip side of that, I've come across business owners I spoke to and tried to persuade into getting some coaching or join the mastermind. They're like, no, I'm done, I'm completely sick of it. But they're fantastic at ordering and product
Hmm.
development, the stuff that I think is super hard and
Yeah.
importing, but they're just not very good at marketing on Amazon. Now, frankly, so many people are good at marketing on Amazon these days, or you can hire agencies, even if you're not good,
Yeah.
that are pretty on up to date with that, but they're not very, the hard thing is developing products and getting the economics of that to work. So I was desperately trying to persuade him to sell his business for tons of money, and he said, "No, I'm not really that interested, but you can put me in touch with somebody if you want." So that these people are out there who've just kind of given up,
Hmm.
even though actually viewed from a certain angle, there is just a ton of value there. So whether it's a tiny, business that's given up, but
Hmm.
actually they've got a patent on
Hmm.
a formula that's unique and could be worth a lot of money and get you 6 months down the line very swiftly
Hmm.
from developing it yourself, so saving time in essence. Or it's something more extreme where somebody's made several $100,000 a year and just kind of give it up. It's surprising what's out there. It always amazes me, and it's really worth looking,
It
in my
is.
experience.
Yeah, it is. And when you go through this cycle a bunch of times, what you realize is that business is so much harder than just making sales and even making profit. I mean, there's a lot of mindset, a lot of, strategy stuff that has to go into it. And we all fail in our businesses constantly. I heard somebody describing it this way recently. It's like fail on day, today, fail tomorrow, fail the next day, fail 6 days in a row, or take a step. Actually, the way he described it was take a step backwards today, take backwards. So 6 days in a row backwards. And then on the seventh day, you take a 10-step forward leap. But that can get exhausting, and people can just be like, I'm stuck. I don't know how to get unstuck. I've tried to get unstuck a few different ways. This isn't working for me. I'm done. I've reached my limit emotionally,
Yeah.
and time and energy. And a lot of times if you have a spouse, they can be done before you are, and they can make you done. They can be like, you're done with this.
Yeah,
And
I totally hear you on that. I've had that one more than once, and to be fair to the spouse, they were probably absolutely right. The
yeah.
other thing I've seen actually thinking about, but we'll move on in a sec, but this is an important one to camp on, I think. I've recently come across quite a lot of quite despondent e-commerce sellers who are selling now in whatever it is, August, July. They were selling maybe 30%, 50%, or even less of what they were doing a few months before because they were selling into a lockdown where everyone was buying like
Uh-huh.
absolutely crazy.
Yep.
However, if you look on the year-on-year numbers, they're doing incredibly well, but their mentality is dropped relative to what I was used to. And the guy I was mentioning, who I thought was sourcing a really fantastic product and had wrapped
Yeah.
down for me the hard bit of the business model, was actually doing pretty well, but just not as well as he had 2 years ago. And I probably let overhead grow in response, and therefore the profit in the business was looking pretty poor. But if you strip that back out, or if you could duplicate that, as you were saying earlier,
Yeah.
if you've got your back office functions or whatever it is, you can consolidate. That to me felt like actually viewed objectively, not what you've just got used to recently, is fine. But I think a lot of people do get quite despondent based
It's
on fairly recent history of their business. If it's not going up, they're down, if you know what I mean.
if uh, your comments are absolutely identical to a few conversations I've had recently, and it's very interesting that you said that, because there is that recency. It's called the recency effect.
Hmm.
If you're down over the last 3 months, or 60 days, 90 days, you could be emotionally devastated. But if you zoom out and say, "What's my year over year success?" and I've literally had those conversations with people we work with, but it is an emotional roller coaster, and sometimes that is off a cliff, and people are like, "This is not working. I'm done." So anyway, so that's the first thing is don't buy full retail. That's my first tip. Find people
Great.
who are done and work with them. Yeah,
Excellent. So what's your second tip then? Sort of
yeah.
warning.
Yeah. I my second one is don't buy what you don't need and can't afford.
Mhm.
So there's no need for heroics in this situation. You have a good business that's viable. You're an e-commerce operator. Find something that fits in your wheelhouse that you definitely see value bolting into your existing business that will definitely make sense for you and that there's no question about. And then make sure you can afford it. I mean, if don't take a leap financially, that's not worth it. And so go small and find something that you can afford to do and that adds value to existing business. And just be careful not to go too aggressive, I guess would be my tip there. Um, and
Yeah, there
so
was a person who said, I think it was David Packard, the founder of Hewlett Packard, who said more businesses die of indigestion than starvation. Now, that's obviously for the businesses that do a lot of acquisition,
uh,
but there is something about that, right?
mhm.
That if you were buying something if you bite off more than you can chew, that's a coin of phrase,
Yeah.
that could kill your business. And that's a very interesting statement, actually, because I think
Hmm.
most of us haven't had experience of that, but
Hmm.
I think
Yeah.
it could be something that could really derail you quite quickly, right?
Yeah,
Um,
Warren Buffett is again a good person to quote on this stuff. He has tons of business quotes on these types of things. A few quotes that I always loved of his. First of all, he said in terms of investments, uh, you're in a situation like a baseball player at the home plate, a batter. You can take a million pitches, see a ton of things, and never swing. You just can sit there. And so, you don't have to swing at something it's a bad pitch. And so that's a thinking model that I really like. The other thinking model is a quote from him that said, to acquire, in essence, this is what he said. I'll adapt it a little bit, but to acquire what they didn't need, they risked what they did need. And that is foolish. So never put at jeopardy your core business for the hope of somehow acquiring something greater. That's foolish. That's not wise. So you don't want to risk what you have going that's doing well with the hope of growing something bigger. That it's just it's a bad idea. So.
And by the way, just this is one of the correctives to a default entrepreneurial mindset that I've seen, which is swing at everything. And when you're tiny business, when you have no idea what you're doing, and you have very little to lose, that actually
Hmm.
makes quite a lot of sense as a
Hmm.
very raw startup kind of strategy.
Hmm.
However, I think it's really important to transition to more of an investor mentality, which is you're very, very selective. And
Hmm.
that's a
Hmm.
big mental transition that I think that's one of the reasons why this sort of conversation is important for business owners to think about, because
Hmm.
that investor mentality can sometimes be the diametric opposite to the swing at everything, try everything mentality. And that can be a good way to take a business from zero to $1 million a year and then tear it back down again. I think you need to
Hmm.
transition at some point. So that's a great metaphor. I really like that.
Yeah,
So an
totally
obvious
agree.
question we've touched on before, but just very briefly, how do you get the money together? Is it your
Sure.
own
Yeah.
money,
Yeah.
SBO loan? Do you put a group of buyers together? Let's
Yeah,
just quickly
those are
cover that off.
those are the ideas. Yeah, pay from earnings, just cash from your savings account, business savings account. Uh, you can take a loan product. You can do seller financing, where the seller actually gives you terms, and then you can bring in an investor. Those are four common strategies for paying for it. Sure. Yeah.
Okay, so sticking with the how question, what else do you need to look out for when you're buying a business or pitfalls?
Yeah. Another tip I would have is don't fall in love with the business you want to acquire until it's yours. um, and don't overpay and get emotional. Stick to your valuation. In essence, what you're doing is in that mindset of acquisition is you want to see something that is so exciting to you that you want it, and you're willing to make an offer, but not so exciting to you that you lose your mind and that you say, I'm going to acquire this at all costs. And so that's where you want to just stick to your valuation. And so we've done that. We've offered somebody a fair price, and they've said, I want more, and we've held our ground, and then the deal didn't go through. So that happens. And at the end of it, as I look back on the case I'm thinking of, I'm okay.
Hmm,
If I would have gotten the deal done, I would have been happy. Was I willing to pay more? No,
hmm,
no, I don't think I was. And I think in high, because you kind of go through this, like, when you're thinking about it, you really get amped up. You're really like, oh, I want this. But then in the cooler, calmer hindsight of, in 2 or 3 months later, you're like, what was that again? why did I think that was valuable? And so you just want to stick to your guns, and if you create a valuation and you go into the negotiation, be firm about it. and
hmm.
and two good things could happen: either they cave and you don't, and you get what you wanted for the value you thought it was fair at, or they say no, and you don't take a risk, you don't take a gamble, and both of those are good outcomes. So.
I like it's the businesses you don't buy that you're talking about. I
Hmm.
guess
Hmm.
the pitches that you don't take a swing at.
Yeah.
That's very good. As you
Yep.
said, that the best way to negotiate is to genuinely be happy with walking away. And
Hmm.
if at an emotional level, if the seller senses that, you're more likely to get a good deal, as you say, or you just walk away and either there's a good outcome. So
Yeah. Yeah.
the final tip you mentioned before about this, but another sort of warning
Mm-hmm.
about, related to this sort of rushing in where angels fear to tread.
Mm-hmm. Yeah. Final
What's
tip.
your
Final
thoughts?
tip. Yeah. Final
Yeah.
tip is go slow, start small, and add one acquired business at a time, and then see how it goes. And the beauty of this model, it's the great game of e-commerce and entrepreneurship is amazing. It's just so amazing how many, little, I don't know what you call, mental areas of expertise you can geek out over. But the fun of this acquisition effort work is you can evaluate your progress over time. And so things you want to learn as you go, one at a time, methodically, and reflecting on what you're doing is, am I good at adding new businesses to my existing company? If you do one deal and it is a complete disaster that you hated and it was horrible, then you've learned their lesson there. But if you say to yourself after one was done, man, this was awesome, let's go for another one, then you've learned something about your own psyche and your mindset. The second question is, are you good at valuing things and thinking it through? Like, did you do your diligence work properly? Did you evaluate the return on investment? Did you give it time enough so that you evaluate the ROI questions? Is it actually valuable the way you thought it was? And you want to learn that, and it's like, you know, maybe you're wrong about this stuff, and if you need to correct course and reevaluate, then it's wise to do these, sequentially. Third thing you want to learn is, am I good at the deal making with the sellers? That's a whole art, and you want to be good at it. You want to get good where people like you, they know you, they trust you. They would look back and say this was a fair deal. They would look back and say this is a good person. That they would look back and say that these guys weren't, uh, in any way, unprofessional. And so, that's something to learn. And then the third thing is your core business actually growing and benefiting and valuing because of these acquisition strategies? So you want to learn all of these things and a lot of other things about it. But that's I guess the fourth tip is go slow, start small, be methodical, do one at a time, and learn it. Learn your core lessons and take time to reflect back and think about it all.
Yeah, I really love this because I think what it does is make you a better businessman, and it seems to be
Mm-hmm.
a Warren Buffett day today at
Yeah.
the e-commerce leaders house. But Warren Buffett said something like, the better businessman I become, the better investor I become, and the better
Mm-hmm.
investor, the better business person. So
Mm-hmm.
I think what you're saying kind of ties into that really.
Yeah.
So one or two final questions for me. First of all, are there any deals you've lost out on that you're really bummed out about, that you really wish it was the fish that got away?
Yeah. Yeah, actually, there's a couple of deals that we were pretty, deep into the weeds on that did fall apart or didn't work out. One fell apart. Oh gosh, it was a year and a half, 2 years ago now, and I regret it. I didn't bring enough money to the table, and the valuation I thought was fair was a valuation in hindsight that was really me trying to be as riskless as possible. And I basically, we were, I guess, at the altar, you could say, the marriage terms, and we didn't finalize the deal, and it was also a time pressure thing, and I think that was part of the trigger for me. We haven't talked about this, but it's sort of an interesting twist. There was a time constraint, and the seller wanted to be done at a certain time. It was a retirement thing. He was moving and all that, and he wanted done. He wanted out. He had inventory that he was storing, which we haven't talked about inventory. We should talk about that before we wrap up too. But he wanted to be done at a certain time, and I was thinking, I was researching, I was being a little slower than I needed to be, maybe, and he sold to somebody else. And wouldn't you know, the people who he sold it to have just, I mean, it's just a beautiful, beautiful thing. And I could have made it a beautiful thing. And they took it, and it's literally now like, what happened specifically, I can tell you the details. I guess it was an heirloom seed company. And it sounds sort of like a wild, like what in the world, but it's heirloom seed company. And this guy had it for like 45 years, and it was a mature, long established business. And and he wanted to retire. He wanted to. He was moving. I guess I'm just sharing the details. It doesn't matter. But so so that was sort of context. And then so it didn't work. He sold to somebody else, and then I walked into Barnes and Noble and saw the company that he sold to. They had a huge, like this fat, almost like a farmer's almanac, but it was a heirloom seed, huge magazine, like as advertorial, like it was like old fashioned, like that Whole Earth catalogs, you know, those big kind of cool, and it was all heirloom seed stuff, and that was the company, and they were acquiring brands and adding to their empire. So that it was a strategic acquisition for them. And they were much more well suited to do what they did than I would have been. But nonetheless, I would have looked back on that, I think, with some fun. And I think it would have been very profitable. And I lost the deal. And I do look back and think, how can I learn from that? And I think that only takeaway from that for me was I did see value in it that wasn't currently there in its current state. And I guess I was just only marginally satisfied by knowing that another company also saw strategic value in it in a way that wasn't there, you know, in the moment, and that they really did do something amazing with it. And seeing somebody else do really well with it made me kind of reinforce my thinking that I did see value there. I did know what I wanted to do with that business if I would have acquired it, and I just didn't get the chance. And so anyway, so to me,
therapizing your lost deal here.
You can tell this is fun, right? I mean,
Yeah, it's certainly the learning curve. It seems is not just in the acquisitions you make, but the ones that got away. I mean, I would say, to be fair to you, in terms of the truth of what you were just saying about developing, if you like, the trade skills and the emotional trade skills, if you will, that now that you've seen the one that got away and the fact that somebody else built value in it, you've learned to build trust in your evaluation, your instincts for there is value here.
Right.
And so maybe the next similar deal to that you will take, I guess.
Yeah. Anyway, so that's a fun one. And, you know, I think there's lessons to be learned in all scenarios in this, you know, this effort. So there you go. So yeah, that's hopefully this has been helpful.
Yeah, very interesting. By the way, you mentioned inventory and you said that we ought to talk about that. Have we got time to talk about that today, or do you want to do that at another time?
Yeah, let's just add it as sort of a footnote. You know, one of the deal points for e-commerce businesses in particular would be the stock on hand. And how do you understand what value to place on inventory that people have? And to your point, as you made the comment, it triggered my thinking on this, which is, you know, a lot of e-commerce sellers who have come to the point of quitting will have products that they sourced and inventory on hand that is not selling. And, you know, that in their mind, it's an asset. Actually, technically, in many ways, it's just a liability and a cost. And in the reality of it, to them, it's a sunk cost, and they see value in it if they could sell it. The issue is they can't sell it, and the question is, could you sell it? And so that's one of the tricky points of, you know, a physical goods e-commerce business is the inventory on hand. And so you want to just think through that. And really be honest about your ability to move those goods. And, you know, the people can do a lot of shenanigans to juice sales. So you really want to understand, you know, is their sales velocity? Is it declined over time? Is it completely vaporized, or is it completely on the back of very expensive ads that have made it not profitable, but nonetheless have propped up the sales? Those things you want to discover, understand, and really think through before you place a value on inventory. And so the deal, though, at the end of the day, would look something like an offer for the business based on the earnings, and then a payment for inventory on hand. You know, and that would be two parts of the deal in essence. And sometimes you can say, I don't want this and I do want that, or, you know, but there's some sorting out to do there in that regard. And so I wanted to make sure we mentioned that before we wrap up.
Yeah, thank you. I think that's a really important point, which makes e-commerce businesses different from something with more digital assets, for example. And one thing I would say is this is probably a maturity test for the seller. If they genuinely believe that the value of the stock is what they paid for it, and they're stuck in the sunk cost fallacy, they're going to be difficult to do a deal with, I would say. By the way, a lot of fairly early stage people who give up seem to be stuck in this. The more mature people might say that as a negotiating tactic, but the truth is they know and they've done the calculations of what the true value is, and it may be a tenth of what they paid for it, sadly. So that's one of those reality check conversations that may or may not go well depending on the maturity of the seller, I would suggest. So listen, fascinating stuff, and thank you, by the way, for sharing the things that didn't go your way as the ones that did. The ones that did, so really huge learning for me from today's conversation. Really, really fascinating. Can you summarize a few takeaways from today's sort of how you evaluate the deal, what kind of deals you should do, the hows,
Sure.
do's and don'ts?
Yeah, I would just say the first question is, does the business you're looking at acquiring add strategic value to your work? If it does, then it's an interesting opportunity to pursue. And then the second question is, can you acquire it at a reasonable price? You don't know that until you get into the negotiation. So those are the two top level triggers to think through. And if those things can start to sort themselves out, then the tips are, don't buy retail unless you have to. And don't buy what you don't need and you can't afford. Number three, don't fall in love with the brand or the assets until you've actually acquired them. Be willing to walk away. Number four is go slow, start small, add one at a time, and learn your lessons as you go. When you do those things, you'll start to add real value to your business in a new and interesting way. And I think if you go through this process a few times, you'll become a better business operator for the effort. And there you go. That's the summary.
Love it. Yeah, this is great stuff. Well, now segueing smoothly onto our contest winner, which has got pretty much nothing to do with the topic at hand, but we have been running a contest, obviously, for anyone who wants to subscribe to the show, wherever that may be, Spotify, Apple Podcasts, Google Podcasts, etc. And I believe we have a winner. So tell us a little bit about that.
We do. We ran the contest in the month of July. And so if you're listening to this now afterwards, then thanks for entering all those who did. Rebecca Murray is our winner. She's been contacted already. So that's super exciting. Thumbs up. Thank you so much, Rebecca, for the support for the show. Fun little shenanigan on our side to just have people hit that subscribe button and follow us on their podcast player of choice. So we really appreciate that. It's an honor. So for everybody who entered, I just want to thank you again for your support for the show. It really means a lot for you to share these episodes with your friends, to share them into your Facebook groups, or you hang out with other entrepreneurs, all those kinds of things. I will also just make one final shameless plug at the end of this conversation, if it's all right, Michael. If you have a business asset that you want to sell, and you think there would be an opportunity to talk to me about it specifically, feel free to reach out. The contact form on ecommerceleader.com is available. If you're ready to sell an e-commerce business and you're trying to do what we've described here, where you're networking and you're trying to find somebody to buy it, maybe you don't think it's listable on the big marketplaces, something like that, then please do reach out. I'm currently in the market specifically for home and garden, outdoor and garden brands, and SaaS software related to e-commerce. And so those two things would pique our interest. But there you go. And Michael, if they reach out, maybe you'll become an acquirer of brands. Who knows? So.
Yeah, well, if you've got something that's outside of the sort of facets that you think is more listable in a big marketplace and not in home and garden or SaaS, so outside of Jason's space, then it's probably worth contacting me, because I do know a ton of business brokers and business acquirers. I've got a list of people now I've got pretty close relationships with, and I have actually got some deals going through for some clients so that they know what they're doing. They're good, trustworthy people. So you can always reach out to me. Just Michael at Amazing FBA is probably the easiest thing. So there you go, folks. Not only can you get to subscribe for fantastic advice for free, but you could also potentially sell some assets that you thought you couldn't sell. So all the value here. Jason, it's been a real, really great feet on the ground take on a complex topic. So as ever, thank you, man, for your wisdom and insight. Really a privilege to be part of this thing with you.
Honor to do it, man. Thanks so much. All right, that's the end of our podcast recording. Thanks everybody for hanging out with us. And it's always an honor to be able to live stream these. And I know that a lot of folks are going to be watching the replay as well. And so if you do have questions, hit us up. This is a fun topic, and the networking part of this is interesting. And yeah, so there you go. Great stuff. All right, I'm going to end it there.